know the big four banks in Australia, right? They're practically household names.
Absolutely, everyone knows them.
But how well do you really know them? Especially one that's currently navigating a truly complex strategic transformation.
That's a great point. It's easy to just see the brand name and not what's happening underneath.
Exactly. It's incredibly easy to get tangled up in dense financial reports and, all that market jargon.
Definitely. Walls of text and numbers.
But today, we're cutting through all that noise. We're here to give you the clearest, most insightful view of one of Australia's financial titans.
Looking forward to it.
Welcome to the deep dive. Our mission today is pretty straightforward. We're embarking on a comprehensive deep dive into the Australia and New Zealand Banking Group, or ANZ as everyone knows it.
A major player, no doubt.
We're going to sift through our detailed sources. We've got this fantastic ANZ investment analysis and outlook report here.
Right, a really in-depth fundamental analysis.
And we'll pull out the absolute most important nuggets of knowledge. Think of it as your personal executive briefing.
A shortcut to understanding a complex company.
Exactly. A shortcut to truly understanding where ANZ stands today, its bold ambitions for tomorrow, and, importantly, the significant hurdles it faces.
Because there are always hurdles.
You'll walk away not just informed, but with a nuanced understanding of what truly matters about this banking giant.
That's the goal?
We'll explore how ANZ is strategically repositioning itself, what's actually fueling its profitability, and what's putting immense pressure on it.
That profitability piece is key, especially the pressures.
We'll look at how it stacks up against its fierce rivals and the big, bold moves it's making to secure its future.
Big bits, really.
It's a story of transformation, competition, and capital. So let's unpack this.
Let's do it.
All right, let's kick things off with what our sources tell us is ANZ's pivotal point, a true crossroads in its history.
A really critical juncture for them.
This isn't just business as usual, minor adjustments. It's described as a profound strategic evolution.
Yeah, evolution is the right word. It's not just reacting, it's proactive change.
ANZ is deliberately strengthening its domestic Australian presence, which, let's be honest, has been an area where they've lagged a bit.
Historically, yes. Definitely number 4 in some key areas there.
While simultaneously leaning on the rock-solid foundation of its New Zealand and institutional divisions.
Which are real powerhouses for the group.
It's almost like they're using the dependable profits from those diversified operations to fund a significant transformation right here in their core Australian market.
That's exactly the strategy, using stability to fund ambition.
It sounds like they're making some seriously big bets, wouldn't you say?
Big bets is almost an understatement. This isn't about tinkering around the edges. It's a fundamental reshaping.
Right.
The report clearly highlights this as a strategic evolution, not just a market response. The stability from their diversified earnings, especially out of New Zealand and the institutional side, is absolutely crucial.
That foundation lets them take these risks.
It's like having a deep well of capital and steady revenue that allows them to take these calculated high-stakes risks in Australia without, shaking the entire ship.
Makes sense.
They're making a conscious decision to allocate that strength towards areas where they see the most long-term growth potential and competitive uplift, even if it's costly in the short term.
And those big bets are pretty clear in the analysis. The first, and perhaps most talked about, is the Suncorp Bank acquisition.
Huge news when that finally went through.
This move is explicitly described as scale-driven. For years, ANZ has been in what the report calls an underweight position in the high-growth Queensland market.
Yeah, significantly underweight compared to their peers in a critical state.
So this isn't just about adding a few customers. It's about instantly gaining significant scale, acquiring a strong regional brand.
That Suncorp brand is very strong in Queensland.
And dramatically boosting their customer base, deposits, and, critically, their mortgage book in a market where they've traditionally been a bit behind.
And it gives them a much better deposit base, which is crucial for funding.
This deal actually completed in July 2024, so it's now a done deal. They're in the thick of integration.
That's a critical piece of the puzzle for ANZ. Queensland is a massive growing market, and to be underweight there meant they were missing out on significant opportunities.
Just leaving growth on the table.
Exactly. The Suncorp acquisition is their fast-track solution. It saves them years of trying to organically build market share in an already incredibly competitive environment.
Which would have been a slow, painful grind.
And potentially very expensive in terms of margin sacrifice. Plus, inheriting a well-regarded regional brand like Suncorp brings established customer trust and loyalty, particularly in regional areas.
That's a valuable, intangible asset.
It's about rebalancing their geographical footprint in Australia and immediately strengthening their retail presence.
And then the other truly forward-looking bet is the ANZ Plus digital platform.
Ah, yes, their big digital play.
This isn't just a new app. It's described as a long-term investment designed from the ground up to fundamentally change how they operate.
Built on completely new tech stack, right? Not legacy systems.
Exactly. The goal is twofold: dramatically lower the cost to serve customers and, importantly, capture a new generation of customers who expect a seamless digital experience.
That younger demographic is key for future growth.
What's crucial here, as you said, is that it's built on a completely new technology platform, not just bolted onto their old legacy systems. That distinction feels incredibly important for its success.
It's absolutely critical. Most traditional banks struggle with layers upon layers of outdated IT infrastructure. It's costly to maintain, difficult to innovate upon.
Like digital spaghetti code?
Pretty much. By building ANZ Plus from the ground up, they're sidestepping those legacy constraints. This allows for far greater agility, scalability, and ultimately a much lower cost per customer in the long run.
Which is the holy grail for banks these days.
And they're also strategically targeting younger customers who are digital natives. If they pull this off, ANZ Plus isn't just a new product. It's a potential blueprint for their entire Australian retail operating model,
moving away from expensive branches
towards a much more efficient digital-first approach. It's a very big bet on the future of how people bank.
So these are undeniably ambitious moves, but our sources are quick to point out the inherent balancing act.
Always a balancing act with transformations this big.
These initiatives, especially the Suncorp integration, carry substantial integration and execution risks.
Massive risks. Integrating two banks is incredibly complex.
And let's not forget, they're undertaking all of this amidst a challenging macroeconomic environment and an intensely competitive banking landscape.
Yeah, the timing isn't exactly easy. High inflation, rising rates, intense competition.
It's a lot to juggle, and the risks are real.
Indeed. The integration of Suncorp Bank in particular is a monumental task. You're talking about merging complex IT systems, aligning two different corporate cultures.
Two different ways of doing things.
And a massive effort to combine operations smoothly without disrupting customers. Any misstep here could lead to significant cost overruns, delays, and a failure to realize the expected benefits, the synergies.
Which are a big part of the justification for the deal.
Exactly. On top of that, the current economic climate with inflation, higher interest rates, and cost of living pressures adds another layer of complexity.
People are feeling the pinch.
Banks need to be incredibly vigilant about credit quality while simultaneously pouring resources into these transformative projects. And in Australia, the competition is brutal, so there's very little room for error.
Shifting to their financial health, let's look at a snapshot for FY23 and the first half of FY24. In FY23, they actually saw strong results.
Yeah, FY23 looked pretty good on the surface.
Cash profit jumping a solid 14% to $7.4 billion. That was definitely helped by the rising interest rate cycle, a tailwind many banks enjoyed.
That FY23 performance really tells a story of a favorable market. When interest rates rise, banks typically see their net interest margins. That's the difference between what they earn on loans and pay on deposits expand.
They make more on the spread.
They can often raise loan rates faster than deposit rates, at least initially. So that 14% profit increase was a clear reflection of that helpful environment, on top of solid underlying business performance.
But then that momentum visibly moderated in the first half of FY24.
Yeah, the picture changed quite quickly.
Cash profit was down to $3.55 billion. The report calls it severe margin pressure across the entire sector, driven by intense mortgage and deposit competition.
We've certainly been hearing a lot about that mortgage war.
Absolutely. That moderation in 1H24 is significant because it shows how quickly market dynamics can shift. Despite the earlier tailwinds, that fierce competition for both mortgages and deposits quickly started to eat into their margins.
The squeeze was on.
Banks aggressively cut mortgage rates to win borrowers and had to offer higher deposit rates to attract and retain funding, both of which shrank the profit spread.
It's a race to the bottom sometimes on pricing.
This severe margin pressure isn't unique to ANZ. It's a sector-wide issue, making profitability much harder to achieve, especially when you're also investing heavily in transformation.
Costs are up, margins are down. Tough combination.
Despite these pressures, ANZ maintains a really robust capital position. We're talking about a Common Equity Tier 1, or CET1, ratio of 13.5% as of March 2024.
That's a very strong number, well above regulatory minimums.
That's well above regulatory requirements, and importantly, it's actually supporting a significant $2 billion on-market share buyback.
Shows they have confidence in their capital base.
So they've built a substantial buffer, which gives them options.
That 13.5% CET1 ratio is a bedrock of strength. It means they have a significant pool of high-quality capital ready to absorb unexpected losses without jeopardizing their stability.
Peace of mind for regulators and investors.
Being well above regulatory requirements sends a strong signal of safety and prudential management. The $2 billion share buyback is a direct reflection of this capital strength.
Returning capital to shareholders.
It allows them to return surplus capital to shareholders in a tax-efficient way, which is particularly relevant given a unique characteristic of ANZ's dividends.
And that characteristic is a crucial point for Australian investors, the lower franking level of their dividend.
Yes, the franking issue. Always important down under.
Our sources explicitly state this is a direct consequence of significant contributions from New Zealand and international operations. It makes ANZ quite distinct from its more domestically focused peers.
This is a real aha moment for many Australian investors. Franking credits are a tax benefit unique to Australia, preventing company profits from being taxed twice.
Once at the corporate level, once at the shareholder level.
Exactly. But here's the catch. When a substantial chunk of ANZ's earnings comes from jurisdictions like New Zealand, those profits aren't taxed in Australia.
So no Australian tax paid, no franking credits generated.
Precisely. Therefore, no Australian franking credits are generated for that portion. So while these international earnings bolster the group's overall profitability and stability,
Which is a good thing in itself.
the dividend they support is partially franked, making it less tax-effective for some Australian shareholders compared to, say, a fully franked dividend from a bank whose profits are almost entirely Australian-sourced, like CBA historically.
So it's a trade-off.
It's a trade-off. Diversified global earnings resilience versus local tax efficiency.
This brings us to a fascinating competitive duality for ANZ, which defines its core challenge and opportunity.
Two very different market positions.
In Australia, the bank remains the fourth largest of the big four in the crucial housing loan market.
Trailing the others by a noticeable margin.
But in stark contrast, it holds a dominant number one position in New Zealand.
Clear market leader across the Tasman.
So when you look at that fourth in Australia, first in New Zealand, what stands out to you about this initial overview of ANZ's strategic landscape?
What jumps out immediately is the strategic tension this duality creates. It's almost like two different banks within one group.
Right.
In Australia, they are clearly the challenger, constantly fighting for every sliver of market share. This explains the aggressive Suncorp acquisition and the heavy investment in ANZ+.
They have to fight harder.
They can't rely on being the biggest here. They have to be smarter, more agile, and more efficient. Conversely, their dominant position in New Zealand is an incredible asset.
The cash cow, so to speak.
It offers a stable, highly profitable base that reliably generates earnings and capital, which can then be strategically reinvested into that ambitious Australian transformation.
Funding the fight back home.
It's a strategic balancing act. One market demands aggressive growth and innovation, while the other provides a powerful foundation of strength and predictability. The ongoing challenge, of course, is making sure these two distinct strategies work together seamlessly, rather than pulling the bank in different directions.
A tricky balance to maintain.
Building on that, let's pull back the curtain on ANZ's internal engine, its business model and diversification. To lay the foundation, ANZ was actually founded way back in 1835.
Wow, that's a long history.
And is headquartered in Melbourne. It's currently Australia's second largest bank by assets, though fourth by market capitalization.
Interesting distinction there, assets versus market cap.
It serves a massive customer base of over 9.5 million people with approximately 40,300 employees. But what's truly key here is its highly diversified model, structured across four core divisions.
Providing a broad range of banking and financial products.
Not just in Australia and New Zealand, but globally.
So it's definitely not a single monolithic entity. This segmental analysis really breaks down those four pillars of its business. Let's dive into each, starting with Australia retail.
Yeah, the bit most people interact with.
This is the everyday public face of ANZ in its home market, handling everything from your transaction accounts and savings to mortgages, credit cards, and personal loans.
Exactly. This is the segment most of us interact with. And in the first half of FY24, despite some tough market conditions, this division showed impressive resilience.
Holding up relatively well then.
They saw strong home loan volumes and a solid 5% increase in customer deposits. In FY23, it generated a robust return on equity of 14%.
Which is a decent return.
And it's worth noting that this figure excluded the massive ongoing investment in the ANZ Plus digital platform, which otherwise would have temporarily dragged down the ROE.
Ah, that's an important caveat. So the underlying business is performing.
It's a testament to the underlying strength, even while undergoing a major overhaul.
Then we move to Australia Commercial, which our sources highlight as a key engine of profitability.
Yeah, this is a really important division for them.
This segment specifically serves small and medium-sized enterprises, SMEs, agribusiness, and high-net-worth individuals, offering specialized lending and asset financing.
Business banking, essentially, plus wealth for richer clients.
This is where a lot of the deep, ongoing relationships often live.
Australia Commercial is indeed a powerhouse. It delivered the highest return on equity for the entire group at an impressive 26% in FY23.
Wow, 26%. That's huge.
That's no small feat and reflects the often higher margins and deeper customer relationships you find in commercial banking. In 1H24, it contributed roughly 19% of the group's total profit.
So nearly a fifth of the profit from this division alone.
Showing strong year-over-year growth of 7% in business lending and 3% in deposits. This consistent high-margin contribution is absolutely vital for funding the group's broader strategic ambitions, especially those costly Australian retail transformations.
The third pillar is institutional. This division serves a very different client base: governments, global institutions, and large corporate customers across approximately 30 markets.
The big end of town: transaction banking, markets, corporate finance.
Their services include transaction banking, corporate finance, and sophisticated markets products.
The institutional division has actually undergone a significant strategic transformation itself. It successfully de-risked its operations and deliberately pivoted towards more capital-efficient activities.
Moving away from things that tie up lots of capital.
Exactly, like digital payments platforms and currency trading. Essentially, they shifted away from areas that tie up huge amounts of the bank's precious capital to those that generate strong returns with less capital intensity.
Smart move in the current regulatory environment.
This refocus has paid off handsomely. In 1H24, this division posted a record ROE, driven by a remarkable 30% increase in customer revenues from its markets business, half on half.
A 30% jump, that's massive.
It's a fantastic example of a successful strategic pivot.
And finally, a true cornerstone of the group's performance: New Zealand.
The jewel in the crown, some might say.
ANZ is the largest bank there, the undisputed market leader, offering a full suite of retail, commercial, and wealth management services.
The New Zealand division is, in many ways, ANZ's stable anchor. It consistently delivers strong, reliable results, with a 16% ROE in FY23, making it a powerful and consistent profit engine.
Very solid returns year after year.
Despite some challenging economic conditions in 1H24, it maintained its market leadership, with lending up 1% and deposits growing 2%. This dominant, profitable, and stable franchise provides a critical counterbalance to the more competitive and investment-heavy Australian operations.
That balancing act again.
Reliably generating earnings and capital for the entire group.
Now, this leads us to a really interesting and often overlooked point about geographic and revenue diversification, which brings us squarely back to the franking credit factor we touched on earlier.
Right, connecting the dots here.
The key insight here is that while Australian operations are the largest, the New Zealand franchise is an absolutely critical contributor to the group's overall earnings. This geographic mix is a defining feature of ANZ.
And here's where that aha moment truly crystallizes for our Australian listeners. The strong performance of its businesses outside Australia, particularly in New Zealand, directly impacts shareholder returns in a unique way.
Because of those franking credits, or lack thereof?
Because profits from these international jurisdictions don't generate Australian franking credits, ANZ's dividends are often only partially franked. This is a key distinction from its more domestically focused peers like Commonwealth Bank.
So you get less of that tax benefit with ANZ dividends.
It provides ANZ with immense earnings resilience from a broader geographic base, but it comes with a different tax proposition for Australian investors who might typically expect fully franked dividends. It's a strategic trade-off they've made for greater stability.
Stability versus tax efficiency for locals. Got it. Let's turn our attention to loan portfolio quality and composition, which is all about how ANZ manages its risk.
Absolutely crucial for any bank. How risky are their loans?
The report notes that gross loans and advances stood at a staggering $711 billion at the end of FY23.
That's a massive amount of lending, which underscores the importance of a well-managed portfolio. When we look at the composition, residential mortgages are, not surprisingly, the largest asset class.
Same for most banks, right? Mortgages are the biggest chunk.
Consistent with the broader banking sector. For example, in New Zealand, residential mortgages made up approximately 71% of ANZ's total lending as of June 2024.
So heavily weighted to housing over there.
But their loan book is smartly diversified across other areas, like business lending, agriculture, a key sector in New Zealand comprising about 10% of their local loan book, and unsecured consumer credit.
So not all eggs in one basket.
This diversification is fundamental to sound risk management.
What's truly fascinating here is their laser focus on quality and a deliberate strategy to de-risk the portfolio.
Yeah, this has been a major theme under the current CEO.
Our sources highlight that management has pursued a deliberate and consistent strategy to de-risk since 2016. What exactly did that involve on the ground?
This de-risking strategy has been a cornerstone of CEO Shane Elliott's approach. It involved a very conscious effort to reduce exposure to historically higher loss segments while proactively growing lower-risk assets.
Like pruning the riskier branches.
Think of it like a gardener pruning a plant to make it stronger. Specifically, they significantly slashed their unsecured retail lending, things like personal loans and credit cards,
Which can go bad quickly in a downturn.
cutting their exposure in those riskier areas from 7% to just 3% of their exposures at default, or EAD. Conversely, they grew lower-risk segments, such as mortgages and lending to sovereigns and other banks, by a massive $229 billion.
Wow, and nearly $250 billion shifted.
Increasing their share of EAD from 59% to 64%. They also aggressively improved the quality of their corporate lending by increasing the investment-grade component by 70% and reducing non-investment-grade lending by roughly a third.
So systematically improving the quality across the board.
A huge effort over several years.
So the implication here is that this comprehensive reshaping results in a structurally lower risk profile. Essentially, they've completely revamped their loan book to be far less risky,
Deliberately engineered to be safer.
putting them in a much stronger position to ride out any future economic wobbles or downturns.
Precisely. This proactive and consistent management of the loan book significantly enhances their resilience. By reducing their vulnerability to segments that are historically more volatile and prone to higher defaults during economic contractions, they've built a stronger, more robust portfolio.
Which is exactly what you want heading into uncertain times.
This is absolutely vital in a challenging macroeconomic environment, allowing them to better withstand potential credit cycle downturns and mitigate the severity of credit impairment charges. It's a fundamental strength they've deliberately cultivated.
It really shows foresight.
What's truly fascinating here is how ANZ uses its diversified portfolio not just for growth, but as a strategic asset to actively manage risk and fund its ongoing transformation.
Using diversification as a tool.
This raises an important question. In the cutthroat world of banking, and with its unique position across two markets, how does this diversification actually play out on the competitive battlefield?
That's a perfect lead into our next segment, the battlefield industry dynamics and competitive positioning. Let's start with what we all know as the Australian oligopoly.
The Big Four dominance.
The Big Four, CBA, Westpac, ANE, and ANZ collectively hold an incredible 72% of total banking system assets.
Just massive market concentration.
That's a massive concentration of power, but it also creates an intense fight for market share.
It absolutely does. This highly concentrated structure inherently fosters intense competition, especially in the lucrative residential mortgage market.
Everyone wants a piece of that mortgage pie.
This intensity is a major reason why we've seen significant net interest margin, NI, compression across the entire sector. With only a few major players, they often end up competing fiercely on price for market share, which inevitably eats into their profitability.
It becomes an arm wrestle on price.
It's a constant arm wrestle.
And within that arm wrestle, ANZ's Australian position places it as the fourth largest of those major banks in crucial retail segments.
Clearly number 4 in home loans.
As of June 2025, its market share in housing loans was around 14%, trailing CBA at 25% and Westpac at 21%.
a significant gap to the leaders.
In household deposits, it held about 13.6% in July 2024 compared to CBA's 25.3%.
Also trailing significantly in gathering those sticky household deposits.
This relative underweight position is precisely what makes the Suncorp acquisition such a compelling and frankly necessary strategic move.
It directly addresses that market share weakness.
It's a significant strategic challenge for ANZ. The acquisition is the primary rationale for lifting its combined household deposit share to 16.0% and crucially bolstering its presence in the fast-growing Queensland market.
Gives them a fighting chance to close the gap, especially in deposits.
Without such a bold move, gaining substantial organic market share against such dominant incumbents would be an incredibly difficult and slow battle.
Almost impossible without sacrificing profitability completely.
Potentially requiring unsustainable pricing strategies that would further erode margins.
So buying scale was the logical, albeit risky, alternative.
Now let's contrast that with the New Zealand stronghold, a completely different story.
Night and day compared to Australia.
ANZ is the undisputed market leader there, the largest bank with approximately 30% market share in both lending and deposits.
Dominant. Just absolutely dominant.
It's a stark and powerful contrast. In New Zealand, ANZ's scale is considerable, with total assets of NZD $200.9 billion as of March 2025, making it substantially larger than its nearest competitors.
That scale gives them huge advantages over there.
Data from the Reserve Bank of New Zealand also shows exceptionally strong prudential metrics, a 17.4% total capital ratio, a remarkably low 0.9% non-performing loan ratio, and a solid 1.4% return on assets.
Those are really impressive numbers. Shows a well-run, profitable, low-risk operation.
These metrics underscore robust risk management and operational efficiency, showcasing a truly dominant market position.
They really run a tight ship in NZ.
So this dominant and profitable position in New Zealand isn't just a nice to have, it provides a stable and significant source of earnings, acting as a crucial partial hedge against the more intense Australian competition.
It's the engine room providing stability.
That gives them significant strategic leverage and financial muscle.
It's an invaluable asset for the group. While Australian competition can aggressively squeeze margins and demand significant investment, the New Zealand business reliably generates substantial profits and capital.
A reliable profit generator.
This geographic diversification reduces the overall group's exposure to any single market's competitive or economic pressures, providing a crucial, stable foundation that helps fund the riskier, yet potentially higher reward, Australian transformation initiatives. It really is a powerful strategic advantage.
Beyond the traditional players, the competitive landscape is constantly evolving. We're seeing evolving competitive pressures from non-bank and fintech lenders.
The disruptors or potential disruptors.
The report states that while neobanks, those fully digital challenger banks, have had a limited impact so far.
Yeah, the neobank hype hasn't quite translated into market share here.
Non-bank lenders and private credit funds are creating significant competition in niche segments like business lending.
That's where the pressure is perhaps more acute in specific product areas.
That's a nuanced but incredibly important distinction. While the direct threat from new digital banks hasn't fully materialized in Australia, the broader fintech disruption is absolutely real and accelerating.
It's chipping away at the edges, changing expectations.
The Australian fintech market, for example, is projected to more than double to USD $9.5 billion by 2033, with areas like payments and buy now, pay later, BNPL, leading the charge.
Huge growth expected in those fintech niches.
This isn't just about new products, it's about fundamentally altering customer expectations and interactions with financial services.
People expect slicker, easier digital experiences now.
And the report really zeroes in on the real threat, which is less about direct competition across all products and more about disintermediation of the customer relationship.
This is the crucial point. Losing the main connection with the customer.
This means fintechs are often capturing those key customer interactions, those daily touch points, with superior user experiences.
Like payments or budgeting apps.
When that happens, it weakens the incumbent's ability to gather valuable data and, critically, to cross-sell other products.
If you don't own the interface, you lose the data and the sales opportunities.
This truly highlights the strategic importance of ANZ's investment in its own digital platform, ANZ Plus, as a defensive and offensive play.
This is perhaps one of the most significant long-term threats to traditional banks. Imagine if your primary financial interaction isn't with your bank's app, but with a third-party payment provider or a budgeting tool.
The bank just becomes a utility in the background.
If fintechs own that primary customer interface, banks lose the valuable data they need to understand customer behavior, personalize offerings, and effectively cross-sell higher-margin products like mortgages, personal loans, or wealth management.
Which is where they make their real money.
ANZ Plus is their direct answer to this. It's an attempt to reclaim that digital relationship and ensure they remain at the center of their customers' financial lives, rather than being relegated to a back-end utility provider.
It's about securing future profitability by owning the customer experience.
A fight for the future customer interface. All of this, of course, happens within a really strict regulatory environment.
Always the regulators looking over their shoulder.
ANZ operates under a stringent regulatory framework by APRA, the Australian Prudential Regulation Authority, which sets the rules for how banks operate.
APRA's oversight is incredibly comprehensive and rigorous, especially in the wake of the 2018 Royal Commission. Their capital requirements, which are based on global Basel III standards, demand unquestionably strong capital levels.
That 10.5% minimum CET1 we talked about. Effectively, a 10.5% minimum CET1 ratio for major banks. While this ensures financial stability and creates high barriers to entry for new players, it also directly limits how much leverage banks can take on and heavily influences their capital return policies, like dividends and share buybacks.
So regulation directly impacts strategy and returns.
Massively.
And then there's open banking, officially known as the Consumer Data Right, or CDR.
Open banking, meant to revolutionize competition.
The idea behind it is to empower consumers to securely share their financial data with third parties, theoretically increasing competition and making it much easier to switch providers.
In theory, open banking has transformative potential, aiming to put consumers in the driver's seat. But the reality check from the report is that its progress has been slow on the ground.
Hasn't really taken off yet.
Consumer adoption is still very low at just 0.31% of bank customers at the end of 2023. And there have been technical issues, such as high consent authorization failure rates, nearly 30%, which have hampered its effectiveness.
So teething problems are holding it back.
So, while the long-term potential for greater competition remains significant, its near-term impact on major banks' competitive positions has been limited. It's more of a slow burn than a rapid disruption.
Interesting. All right, we've talked strategy, competition, and risks. But now, here's where it gets really interesting. How does ANZ actually perform financially in this complex environment, especially compared to its peers?
Time to crunch the numbers.
Let's dive deep by the numbers now, looking at ANZ's financial performance from FY22 through the first half of FY24. Starting with our profitability deep dive.
The bottom line.
The report notes that FY23 saw a robust 14% increase in cash profit to $7.4 billion. This was largely thanks to margin expansion, a lovely tailwind from rising interest rates.
As we discussed, that rising rate cycle was a big help.
But then, in 1H24, that momentum visibly slowed, with cash profit declining 7% from the prior period to $3.55 billion.
A noticeable dip.
This clearly reflects that challenging operating environment we just talked about.
That contrast between FY23 and 1H24 is quite stark and tells a compelling story about market volatility. The rapid rise in interest rates through FY23 allowed banks like ANZ to expand their net interest margin, or IN.
That crucial profit driver.
That crucial difference between the interest they earn on assets like loans and the interest they pay on liabilities like deposits. ANZ's NIM actually expanded by 7 basis points in FY23 to 1.70%, really boosting the bottom line.
Riding that wave.
But then, that trend reversed sharply in 1H24, didn't it?
It sure did. The report highlights that the average NIM for major banks compressed by 11 basis points year over year to 179 basis points, with ANZ recording 156 basis points for the half.
Ouch. A significant squeeze there for ANZ specifically.
That's a direct hit to the bottom line, stemming from what the report calls aggressive price competition for both loans and deposits.
Precisely. That sharp reversal in NIM for 1H24 is the critical takeaway here. It underscores how quickly competitive dynamics can shift, even if the underlying interest rate environment is stable.
Competition bites hard.
When banks fiercely compete on mortgage rates to attract new borrowers, or on deposit rates to retain and grow their funding base, the first thing to get squeezed is that net interest margin. This aggressive pricing war reduces the profitability of each dollar lent, directly translating to lower net profit, as we saw with ANZ's moderation in 1H24.
A powerful illustration of those competitive pressures.
It really is.
Now, let's look at return on equity, or ROE, which is a key measure of how efficiently a bank generates profit from its shareholders' capital.
How much bang for the buck shareholders are getting.
Cash ROE improved to 10.9% in FY23, up 54 basis points from FY22. However, it moderated to 10.1% in 1H24, or a slightly better 10.7% if you exclude the capital held specifically for the Suncorp acquisition.
So, holding relatively steady, but not spectacular compared to history, perhaps.
While that's a solid performance in absolute terms, it's important to put it in context. The report indicates that ANZ's returns, while decent, still lag the sector leader, Commonwealth Bank,
CBA always seems to lead on ROE, doesn't it?
which saw a full-year ROE of 13.1% in FY24 compared to ANZ's estimated 9.4% for FY24.
That noticeable gap in ROE is a factor the market always scrutinizes when valuing bank stocks, and it's something ANZ's aggressive strategic initiatives are specifically designed to address over the long term, trying to close that gap.
Moving to operational efficiency, which is all about managing the cost base effectively, the cost-to-income ratio is a key metric.
How much it costs to make $1 of income.
This ratio improved to 48.5% in FY23, down from 52.0% in the prior year. On the surface, that looks like good progress.
It does, but we need to look deeper into the underlying pressures. In 1H24, operating expenses actually rose 4% compared to the second half of 2023.
So costs are creeping up again. Why?
This increase was driven by broader inflationary pressures across the economy and, crucially, the ongoing necessary investment in new technology and meeting complex compliance requirements.
Tech and compliance costs the usual suspects.
So while they're making efficiency gains, they're fighting against significant headwinds.
The report mentions $200 million in productivity initiatives achieved in 1H24, which is a substantial saving.
They are finding savings, which is positive.
But these gains are being absorbed by significant strategic investment in the Suncorp integration and ANZ+.
So the savings are being reinvested straight back into the transformation.
So they're almost running just to stay in place in terms of costs, at least for now.
That's an astute observation. The $200 million in savings is commendable and shows their commitment to efficiency, but the sheer scale of investment in the Suncorp integration and ANZ Plus means those savings are immediately reinvested into building the future bank rather than flowing directly to the bottom line as increased profit.
Makes sense strategically, but doesn't help short-term profit numbers.
The future indicator here will be the long-term trajectory of that cost-to-income ratio. If these strategic bets are successful, they should lead to a structurally more efficient business, and we should eventually see that ratio improve more sustainably. But for now, it's a phase of elevated, necessary investment.
Now, on to asset quality and provisioning, which generally paints a reassuring picture of resilience.
How are the loans holding up?
Credit impairment charges, which are provisions for bad and doubtful debts, remain remarkably low, with a modest $70 million for 1H24.
That's a very low number for a bank this size. Reflects that de-risking effort.
That's a strong testament to their proactive de-risking strategy and generally prudent lending standards we discussed earlier, while loan delinquencies are ticking up slightly from cyclical lows, which is to be expected.
You'd expect some rise with higher rates.
As interest rates rise and cost of living bites, they remain contained. Mortgage payments 90 or more days past due, for example, have risen slightly, but are still low by historical standards.
There's no major alarm bells ringing on bad debts yet.
Importantly, approximately 79% of ANZ's home loan customers were actually ahead on their repayments as of March 2024.
Wow, nearly 80% ahead. That's a huge buffer.
That provides a substantial buffer against financial stress in the housing market and speaks to the quality of their customer base.
It's just borrowers are managing okay despite the pressures.
And their provisioning levels seem quite conservative, acting as another layer of defense. The collective provision balance stood at $4.0 billion at the end of 1H24.
That's the war chest set aside for potential future losses.
Crucially, this is $2.2 billion above the bank's own base case economic scenario, indicating a conservative posture and a significant buffer.
So they're provisioned for worse conditions than they currently expect. Very prudent.
This conservative provisioning is a key strength and a sign of strong financial prudence. It means they've proactively set aside substantially more capital than their base economic forecasts suggest they might need.
Ready for a rainy day, if it comes?
This positions them very well to absorb potential future credit losses if economic conditions were to deteriorate unexpectedly, or if the challenging macroeconomic environment takes a sharper turn.
A sign of good risk management.
So how does ANZ actually stack up when we do some crucial peer benchmarking against the other big four?
The head-to-head comparison, always revealing.
This comparison provides absolutely essential context for understanding their performance.
It truly does. While we could dive into a full table of figures, the key insight is clear. ANZ's core profitability metrics, like net interest margin and return on equity, generally lag the market leader, Commonwealth Bank.
Consistently playing catch-up on profitability.
At the same time, its cost-to-income ratio is often higher than both CBA and NAB. This performance profile directly reflects its ongoing heavy investment phase and its historical underweight position in the Australian retail market.
So the numbers reflect the strategy and market position.
Exactly.
Let's quickly highlight some of those critical differences. For net interest margin, which, again, is the core profit engine, ANZ consistently lags. In FY23, it was 1.70%, trailing CBA at 2.07%. And that gap persisted in 1H24.
Lower margins mean less profit on each loan.
For cost-to-income ratio, a higher number means less efficiency. ANZ was 48.5% in FY23, notably higher than CBA at 43.5%.
Costing them more to generate income.
This indicates the significant upfront costs they're shouldering for their strategic transformation. And finally, cash return on equity, how much profit they generate from capital ANZ was 10.9% in FY23, well below CBA's 14.0%.
Again, lagging the leader on that key shareholder return metric.
However, there's one area where ANZ is clearly a sector leader. It's CET1 ratio, that measure of high-quality capital.
The capital strength ace up their sleeve.
In September 2023, ANZ was at 13.3%, ahead of CBA and NAB. By March 2024, it had actually risen to 13.5%, remaining sector-leading and well above its peers.
That exceptional capital strength is a defining characteristic, gives them options and resilience.
So the overall conclusion here is that while ANZ has sector-leading capital, giving it incredible resilience and options, its core profitability metrics like NIM and ROE lag its dominant competitors, and its cost-to-income is higher.
A mixed bag, really. Strong capital, weaker core operating performance relative to peers.
This really underscores the narrative of a bank in a deep, costly investment phase.
If we connect this to the bigger picture, the financial metrics tell a story of deliberate strategic shifts. They're making calculated sacrifices in short-term profitability to build a stronger, more competitive future.
Investing today for returns tomorrow.
But what exactly are those shifts designed to achieve? And more importantly, how are they actually progressing on the ground? This raises an important question. What does ANZ's ambitious roadmap look like, and how is it funded?
Let's chart that future now.
Let's chart the future now by looking at ANZ's key strategic initiatives and capital allocation. The digital banking transformation with ANZ Plus is truly meant to be the future foundation of their Australian retail business.
Not just an add-on, but the core going forward.
As we touched on, the strategy isn't to layer a new app onto old systems. It's built from the ground up as a new technology platform, designed for speed, efficiency, and a seamless customer experience.
Right, so this is a completely new engine under the hood.
Right.
The initial focus for ANZ Plus was straightforward. Attract new customers and deposits.
Using those high-interest savings accounts as bait.
Primarily through high-interest savings accounts and a superior user experience. But here's the crucial current shift. The strategic priority has now moved to deepening engagement.
Moving beyond just savings.
And converting those initial users into primary banking customers for everyday transactions, bill payments, and eventually lending. They want full, sticky relationships, not just savings accounts.
That pivot is absolutely key for profitability. Acquiring customers with attractive savings rates is one thing, but converting them into multi-product relationships is where the real value and stickiness truly lie for a bank.
Gonna make money off them eventually.
And the performance has shown significant early success. By September 2024, they had accumulated 848,000 customers and $16 billion in deposits.
Those are big numbers pretty quickly.
What's particularly promising is that approximately half of these customers are new to ANZ, demonstrating its ability to attract customers beyond their existing base, which speaks volumes about its competitive potential.
So it's bringing genuinely new people to the bank. That's impressive.
Very promising early signs.
And then we have the acquisition and geographic expansion with Suncorp Bank, which is explicitly about filling a gap.
Plugging that Queensland hole.
The strategic rationale explicitly addresses a key structural weakness for ANZ, its historical underrepresentation in Queensland. This acquisition provides immediate scale and a significant boost to their customer base, deposit franchise, and mortgage book in that critical market.
This is a direct, decisive response to a clear market deficiency. ANZ needed to strengthen its position in Queensland, a growing state, and the Suncorp acquisition was the most direct and rapid way to achieve that.
Buying market share instantly.
A transaction status confirms it was completed on July 31st, 2024, after a lengthy regulatory review process, including an initial block by the ACCC that was later overturned by the Australian Competition Tribunal.
That was quite the saga, wasn't it? The regulatory battle.
It was. That overcoming of regulatory hurdles is significant. It highlights the strategic importance and the strength of the arguments made to allow the deal to proceed.
Shifting gears, the Asian market strategy has seen a complete retreat and refocus.
A major pivot from past ambitions.
There was a past ambition to be a super-regional bank, building a major retail and commercial presence across Asia, which involved significant acquisitions like parts of RBS's businesses back in 2009-2010.
That super-regional strategy was undeniably bold, but ultimately proved to be costly and delivered low returns. Under current leadership, that strategy was decisively unwound due to low returns.
A pragmatic retreat from a strategy that didn't work.
This led to a strategic pivot where in 2016-2017, ANZ divested its retail and wealth management operations in key Asian markets like Singapore, Hong Kong, China, Taiwan, and Indonesia to DBS Bank.
Selling off those retail arms.
There was a clear strategic withdrawal from that broad retail Asian pivot that had become a drain on capital and resources.
So their current focus in ERA is squarely on the less capital-intensive, higher-returning institutional business.
Playing to their existing strengths in corporate and institutional.
This means facilitating trade and capital flows for large corporate and institutional clients across the region, a much more targeted and arguably smarter approach.
Absolutely. It's about playing to their strengths in transaction banking, foreign exchange, and corporate finance, where they have deep expertise and established relationships, rather than trying to compete in crowded and capital-intensive retail markets across diverse Asian geographies.
Focus on what you do best.
This pivot reflects a disciplined focus on capital efficiency and maximizing profitability from existing strengths.
Similarly, in wealth management, they've gone through a process of simplification and specialization.
Another area they've pulled back from, in the mass market at least.
They've largely exited mass market wealth management, a decision driven both by industry-wide reputational issues, particularly after the Royal Commission.
The Royal Commission really changed the game for wealth management.
And a broader simplification strategy. Selling their 51% stake in the ING Australia joint venture back in 2009 was a key early step here.
That decision was a pragmatic one. The mass market wealth business had become increasingly complex, costly to manage, and fraught with significant regulatory and reputational risks.
Just wasn't worth the headache anymore for many banks.
Their current offering is now highly specialized, focused on higher margin clients, high net worth and private banking clients within its Australia commercial and retail divisions.
Serving the wealthy, where margins are better.
This allows them to allocate resources far more efficiently to client segments where they can truly add value and generate stronger returns.
All these strategic moves are underpinned by their incredibly strong capital allocation and shareholder returns, reflecting their balance sheet strength.
Back to that strong capital base.
Their capital adequacy, specifically the CET1 ratio, is exceptionally strong at 13.5% as of March 31st, 2024. And they've been consistently generating capital, moving from 12.3% in FY22 to 13.3% in FY23.
This consistent capital generation and robust CET1 ratio are fundamental to their strategic flexibility. This level is significantly above APRA's unquestionably strong benchmark of 10.5%.
A very comfortable buffer.
Management has even proudly described ANZ as among the best capitalized banks in the world. This strong capital base isn't just for resilience and safety. It's a critical strategic asset that provides the financial firepower for growth initiatives and generous shareholder returns.
And speaking of shareholder returns, their share buybacks have been significant. In May 2024, the board approved a share buyback of up to $2 billion,
That's a huge buyback program.
which is described as one of the largest in the bank's history.
This substantial buyback program is a direct result of that strong capital position, further supported by organic capital generation and capital freed up from the partial sale of their AmBank stake in Malaysia.
Funding it through existing strength and asset sales.
Share buybacks are a flexible, tax-effective method of returning capital to shareholders, particularly for a company with a partially franked dividend stream. It's a way to enhance shareholder value beyond just the dividend, offering a complementary mechanism for capital return.
Especially relevant given that franking issue. On that note, let's talk about their dividend policy. They've had recent payouts of 175 cents per share for FY23, a 20% increase, and an 83 cents interim dividend for 1H24.
Decent dividend payments.
But, as we discussed, the franking levels remain a critical feature for Australian investors. The final dividend for FY23 was only 56% franked, and the 1H24 interim was 65% franked.
So less than two-thirds franked recently. A noticeable difference from fully franked.
This declining franking level is a direct result of their successful geographic diversification strategy. A significant portion of their earnings is generated in New Zealand and Asia, where Australian corporate tax is not paid.
Meaning no franking credits are generated on that offshore profit.
This presents a clear trade-off for Australian investors. While international operations provide earnings resilience and valuable diversification, they dilute the tax effectiveness of the dividend for Australian investors.
It's the price of that geographic diversification from a tax perspective.
The large-scale share buyback, in this context, can be seen as complementing this, offering a tax-efficient return of capital that balances the partially franked dividend stream.
A smart way to balance the total return package for shareholders.
It's a key consideration for how investors evaluate ANZ's total return. So we've laid out the strategy, the funding, and the challenges. What does this all mean for investors and anyone truly trying to understand ANZ's future trajectory?
That's the ultimate question, isn't it? It means ANZ is navigating a complex landscape by actively shaping its own future, rather than simply reacting to market forces.
Taking control of their destiny, so to speak.
They're trying to re-engineer their core Australian business while leveraging the strengths of their international and New Zealand operations. For investors, it's about understanding that ANZ's risk-reward profile is undergoing a significant shift.
A different kind of investment proposition than it used to be.
There's a clear vision towards a more focused, digitally enabled, and capital-efficient future. But the journey involves considerable execution risks that the market is definitely pricing in, as we saw with the valuation discount.
The market sees the potential, but also the hurdles.
Precisely.
Finally, let's turn our attention to the human element and future outlook. Starting with management quality and corporate governance, essentially, the steering wheel of this entire operation.
Who's driving the bus and how well are they governed?
Shane Elliott, as CEO since January 2016, has really driven a clear strategic vision.
Shane Elliott's tenure has been truly transformative. He's been the architect of this strategic vision focused on simplification, de-risking, and strengthening the core franchise.
Consistency in strategy since he took over.
This involved bold and difficult moves like the decisive exit from Asian retail banking and mass market wealth management, which were significant pivots away from previous strategies. His current focus on the Suncorp integration and the ANZ Plus digital transformation are the latest large-scale manifestations of this consistent strategic direction.
He's clearly not shying away from big, necessary changes.
He needs to have a clear plan and isn't afraid to execute it.
He's supported by an executive committee with clear accountability, including key figures like Antonio Watson, CEO of the Powerhouse New Zealand division,
Who runs that critical NZ operation.
and Claire Morgan, Group Executive for Australia Commercial. So a strong leadership team is definitely in place to execute these ambitious plans.
An experienced and accountable executive team is absolutely vital for executing such a complex transformation. Having strong leaders in critical, high-performing divisions like New Zealand and Australia Commercial ensures that the day-to-day operations remain robust and profitable, even as the broader strategic shifts are implemented.
Keeps the existing engines running while building the new ones.
Their experience helps navigate the inevitable challenges of such a large-scale transformation.
And in terms of corporate governance, the board composition, as of August 2023, includes 8 independent non-executive directors and 1 executive director, the CEO.
A strong independent majority on the board.
With an independent chair, Paul O'Sullivan, that structure ensures a strong majority of independent oversight, which is crucial for a financial institution.
Strong independent oversight is paramount for investor confidence and effective risk management, especially in a bank of ANZ's size. The non-operating holding company, NOHC structure, implemented in January 2023,
That new holding company structure.
establishing ANZ Group Holdings Limited, ANZ.GHL, as the new listed parent, is also a significant governance development. It's designed to enhance resolvability, meaning making the group easier to manage in a crisis and to align with evolving regulatory expectations for large, complex financial institutions.
Making it cleaner for regulators, essentially.
It's a structural enhancement for stability.
The board is also supported by 6 principal board committees, covering everything from audit and risk to ESG, environmental social governance, and digital and technology.
Good detailed oversight across key areas.
That level of detailed oversight really indicates a robust and comprehensive governance framework.
These specialized committees ensure that critical areas of the bank's operations, from financial integrity to environmental responsibilities and the ever-growing technological risks, receive dedicated attention and expertise. Coupled with comprehensive public disclosure via their annual corporate governance statement,
They tell you what they're doing.
it signals a strong commitment to transparency, which is crucial for building and maintaining trust with all stakeholders.
Let's get to the perennial question with any major company. Valuation analysis, is ANZ a buy?
The million-dollar question, or maybe billion-dollar question for ANZ.
Looking at its trading multiples, the trailing 12-month price to earnings, or PE, ratio is in the range of 13.6x to 14.6x as of mid-2025.
So mid-teens PE ratio.
This is an expansion from 11.0x at FY23, and it actually trades at a slight premium to its 10-year average of about 12.8.
That expansion in PE suggests the market may be starting to anticipate future growth or improved earnings from their strategic initiatives, perhaps pricing in some success.
The price-to-book, or PB, ratio, a key metric for banks focusing on their assets, stands at approximately 1.4x.
1.4 times book value, pretty standard territory for a major bank.
And for income-focused investors, the forward dividend yield is in the range of 4.97% to 5.47%.
Still a chunky dividend yield, even with the lower franking.
Which remains a very significant component of any total return from ANZ shares.
Definitely.
But when we do a peer valuation comparison, ANZ actually trades at a noticeable PE discount to some of its major peers. For example, the report lists ANZ at 13.3x PE versus Commonwealth Bank at a staggering 30.5x as of mid-2024-2025.
Wow, CBA trading at more than double ANZ's PE multiple. That's a huge gap.
That's a huge gap that really stands out.
That significant PE discount is indeed striking, and it immediately prompts the question, why the discount?
What's the market seeing?
The report suggests it likely reflects several factors. ANZ's lower Australian market share compared to CBA, its historically lower return on equity, and crucially, the market pricing in the significant execution risks of its Suncorp acquisition and ANZ Plus strategies.
So lower market share, lower returns historically, and the risks of the current strategy.
Investors are clearly weighing the potential future benefits against the challenges and uncertainties of these large-scale transformations. It's a reflection of investor sentiment towards the immediate future.
So given that, what are the key valuation drivers for ANZ going forward?
What needs to happen for the valuation to improve?
A primary long-term driver for any bank's share price is book value growth. Net tangible assets, NTA per share, which is essentially the tangible value per share, has shown consistent growth.
Growing the underlying value of the bank.
From $20.75 in FY22 to $21.78 in FY23, and further to $22.05 by 1H24. Continued profitable growth that adds to this tangible book value is essential for long-term value creation.
Need to keep growing that NTA consistently.
The dividend sustainability is also well supported by earnings and strong capital. The variable here is less about whether the dividend is sustainable and more about its future growth rate and, as we've highlighted, the franking level.
That franking percentage is the wild card.
Which makes after-tax returns differ significantly for various Australian investors.
So book value growth and the total dividend picture, including franking, are key.
Finally, we have to talk about risk assessment. What could go wrong?
The potential pitfalls. Always important.
Starting with credit risk, which is always the most significant concern for any bank.
Absolutely. The risk that if borrowers can't repay their loans.
The bank has substantial housing market concentration in both Australia and New Zealand. A sharp economic downturn leading to increased unemployment and falling property prices would inevitably lead to higher loan losses.
the big macro risk for any mortgage-heavy bank.
While their de-risking strategy and the high proportion of customers ahead on repayments offer mitigating factors, it remains a core vulnerability.
They're better positioned, but not immune.
Beyond housing, there are sector-specific exposures in areas like commercial real estate and New Zealand agriculture,
That 10% exposure to NZ.AU is notable.
which is about 10% of their NZ loan book and vulnerable to commodity price volatility or adverse weather events. Also, broader economic headwinds from inflation and high interest rates could impact small businesses and unsecured consumer lending.
So specific sector risks plus the general economic climate.
Then there's market and interest rate risk. The bank's profitability is highly sensitive to changes in interest rates and competitive dynamics.
We saw that vividly in 1H24 with the rapid in-impo compression.
That 1H24 experience was a clear, real-time demonstration of their net interest margin, NIM, sensitivity. Even in a relatively stable interest rate environment, intense competition can quickly erode margins, directly impacting revenue and earnings.
It's an ongoing, active challenge that management must constantly navigate. Margin management is crucial.
Operational and cyber risks are growing concerns too, especially in our increasingly digital world.
Huge risks these days. System failures, hacks.
Their increasing reliance on digital platforms like ANZ+ makes them a prime target for cyber attacks, which could mean significant financial losses, regulatory penalties, and severe reputational damage.
A successful cyber attack could be devastating.
APRA has flagged cyber resilience as a top priority for the entire industry.
Exactly. And the integration risk for the Suncorp acquisition is substantial. Large acquisitions are notoriously complex. There's always a risk of delays, cost overruns, or a failure to deliver the expected synergies that justify the deal.
Getting that merger right is critical.
We also can't ignore the rising prevalence of scams and fraud targeting customers, which is a growing operational and reputational risk for all financial institutions today, eroding trust and incurring costs.
The scam issue is huge right now.
It really is.
Lastly, there's regulatory and compliance risk. The industry is still under heightened scrutiny post-2018 Royal Commission, leading to elevated compliance costs.
The cost of staying compliant keeps going up.
And new regulations, like APRA's CPS 230 on operational risk and the Financial Accountability Regime, FAR, add even more complexity and demand significant resources.
The regulatory burden is immense, constantly evolving and ongoing. These new prudential standards and accountability regimes aren't just about avoiding fines. They require significant investment in systems, processes, and governance across the entire organization.
More cost, more management attention diverted.
Which directly impacts the bank's cost base and operational focus.
So bringing all of this together into a bull versus bear case synthesis, it really highlights the two distinct sides of the coin when we consider ANZ's future.
The optimistic view versus the pessimistic one.
The bull case for ANZ rests heavily on the successful execution of its strategic transformation. Proponents would argue that the Suncorp acquisition will successfully reweight the bank toward the high-growth Queensland market,
Fixing that geographic imbalance.
significantly improving its domestic earnings profile and market share. They'd point to ANZ Plus's rapid customer acquisition as evidence of a winning digital strategy that will ultimately lead to a much lower cost to serve and a more engaged, profitable customer base.
Banking on ANZ Plus really taking off and delivering.
They'd also emphasize the stability of the New Zealand business and the strong returns from the de-risked institutional division as providing a resilient foundation.
Those stable earnings supporting the transformation.
In this optimistic scenario, the current valuation discount would narrow significantly as these execution risks subside and the benefits flow through to improved return on equity.
The market rewards them for pulling it off.
The bear case, however, focuses squarely on those significant execution risks and persistent competitive headwinds.
What if things go wrong?
Skeptics would argue that large-scale bank integrations like Suncorp are notoriously difficult, and the deal could easily suffer from cost blowouts and a failure to realize those projected synergies.
The integration proves harder and more expensive than expected.
They might also question whether ANZ Plus can truly convert its large base of low-margin savings customers into profitable multi-product relationships.
Does it become more than just a deposit-gathering tool?
Or if it will remain primarily a costly deposit-gathering exercise without generating sufficient cross-selling revenue. This case would also emphasize the persistent margin pressure in the core Australian mortgage market and ANZ's ongoing struggle to gain organic market share against its more dominant competitors,
The competitive pressures just don't let up.
suggesting that profitability could have been constrained regardless of these initiatives, making the investments less impactful than hoped.
So the big bets don't quite pay off as planned. This deep dive into ANZ's journey raises a crucial question for the entire industry. How does ANZ's strategic balancing act between ambitious domestic growth and leveraging stable international earnings reflect the broader challenges and opportunities facing the banking sector globally, not just in Australia and New Zealand?
Absolutely. It's a fascinating case study. We've seen ANZ as a bank in a fascinating high-stakes state of transformation. It's balancing its established strength in New Zealand and institutional banking with ambitious, high-risk bets in its core Australian market through Suncorp and ANZ+.
A real pivot point for the bank.
You've delved into its underlying financial resilience in capital, but also the very real pressures on its profitability. Understanding these strategic shifts, the competitive dynamics, and the inherent risks is truly crucial for anyone looking at the financial services landscape.
Whether you're an investor, a customer, or just interested in the economy.
Whether you're an investor, a business owner, or just curious about the forces shaping our economy.
It touches everyone.
Here's a provocative thought for you to consider. What could be the next game changer for a bank like ANZ or for any major bank once these current transformations run their course?
What comes after Suncorp and ANZ Plus bed down?
Is it purely about achieving even greater scale through more acquisitions, consolidating power in a tight market? Or is it about truly innovative digital offerings that completely reshape customer loyalty, perhaps even moving beyond what we traditionally consider banking products?
Scale versus deep digital innovation.
Consider how the balance between these two strategies, relentless pursuit of scale versus radical digital innovation, might ultimately define the future of banking itself.